22 News in Focus.
Good afternoon and welcome to 22 News in Focus. I'm Barry Krieger. Now, most of us are looking forward to this holiday season, thinking of good times ahead with parties, gift giving, and time with loved ones. Well, something else that's approaching: tax filing season and tax preparation season. Today on 22 News in Focus, we'll be talking about the market impacts, your financial health strategies, and what should be on your year-end financial organizing checklist. Joining me today, we have Mark Teed, Senior Vice President of Investments at Raymond James Associates. Thank you for being here as always, Mark.
Thank you, Barry.
Right off the bat, let's take a look at what happened in the financial markets over the past year, 2019. A year ago around this time, going back a month or so, markets were in free fall. And everybody was there was a lot of panic going on around.
It was a China panic back then. It was worry that the whole thing was going to crater.
And it lasted for months.
It did.
If I remember that correctly.
Really, three full months.
You know, a lot of people were losing sleep. Markets have, however, rebounded. Mr. Stay the Course was validated.
But, you know, the 7 or 8 days before Christmas last year, the market went down 11%. It scared the dickens out of everybody because nobody really knew what was next. But this year, it recovered. Yeah, including us.
I got scared.
So this year, a whole different story. As a matter of fact, this year, the returns are outstanding. We're up about 26% in the S&P 500.
Now, is that 26% from the low of where it was after losing 20%, or it was a correction?
Yeah, it's from the low. So January 1st to now, up about 26%. And the amazing story is bonds are up this year. So nobody expected bond yields to be down, and the price is higher this year. So we got a great bump in the stock market and a great bump in the bond market.
It was a twofer, because usually they say if the stock market goes up, bonds go down. If the stock market goes down, that's where you want to be in bonds. But they both rallied.
Usually one's a hedge against the other. But in this case, they both rallied. So it scares me a little bit when this happens, but I'm enjoying it.
Well, it's always a good idea to be a little bit scared when things are looking too good.
Yes, definitely.
About the bonds, I'm getting off topic a little bit here. Is that because that the Fed raised rates and the lowered rates? I'm sorry, and that the LIBOR and the world interest rates have gone down somewhat? I mean, what's the impact there? Or has this all changed with bonds yet?
Well, Chairman Powell raised rates about 9 times over the last couple of years.
That was scary.
And it looks like he got a little greedy in the last 3 or 4. So he took 3 back, sending a signal to the bond market that he is now prepared to do whatever the market needs to save it. So I think the market took that very positively, that we have very low inflation. Interest rates are going to be very low for a very long period of time. And the bond market's probably a safe oasis now for people. So buyers rushed in.
When we say bonds are rallying, what are we talking about? Are we talking about 2%? Or, I mean, what's a rally in the bond market? I mean, you just said that the stock market's up 26%.
Yep.
How much are bonds up?
Well, the short-term bonds were they weren't up much because yields actually dropped, but the mid to long-term bonds were up between 5 and 10%. So that's a very good return for the bond market.
If anybody could put money in the bank and get 5 to 10%, they'd be real happy about that.
I know.
Bond, it's a whole different animal, bonds, and that takes some conversation with your financial advisor to really get that explained. We're not going to get that cleared up right here, right now. What about market movements worldwide? How does that impact our retirement accounts?
Well, it's all very, very positive because most people have investments in America. They've also got some in international stocks, and they've got some in Asian Pacific stocks. So this has been a pretty good year across the board. Even the worst economies did pretty well this year. Well, stock market wise.
That's encouraging. So I mean, you can be invested in America, you can be invested overseas.
Yep.
China, of course, has impacted the stock market. It almost seems as if Wall Street's listening to what's the latest about the trade deal.
It is.
And every time there's a little bit of a rumor that it's looking good,
yep,
stock market rallies. But I'm noticing that when the opposite is not necessarily as true, and people don't get as frightened now when the stock market drops 200, 300 points.
No, they don't.
Are the investors more sophisticated now?
I think it's the institutional investors now figuring that the Fed is going to backdrop the economy. That they've made it clear that they're not going to keep raising rates until they drive us into a recession. That they've reached their point. So I think the comfort in the bond market has now spread to the comfort in the stock market, and that allows people to even take a little bit more risk and go into Chinese stocks and Asian Pacific stocks. So it starts to really spread, and I think that really started from the Fed deciding not to raise rates anymore.
All right, speaking of China and rumors and all that, one thing I had heard was that, I don't know if it was a bargaining chip by the president, he was talking about maybe not allowing Chinese companies to trade on our exchanges. Have you heard any of that? Is that possible?
Yes, he says an awful lot. And some of it you have to take with a grain of salt, like that. But I think he's making it more and more difficult for Chinese companies to operate the way they have in the past. He just keeps tightening things down, so it makes it more and more difficult. And that's probably a debating strategy or a negotiating strategy for him, because it doesn't seem like it's really had much effect on market players.
That seems to be the art of the deal.
The art of the deal.
What about individual investment portfolios? People tend to be pretty emotional with their money. We saw a lot of that last year.
We sure did.
What do you advise your clients when it comes to downturns, if they get kind of heartbroken about downturns, or if they get excited when it seems to be rallying?
Yep.
How do you keep an even keel?
Well, I can tell you right now, with the market at all-time highs and the bond market doing as well as it did, there's probably a disappointment out there. So we try and just, we'll talk through it and say, at some point there's going to be the threat of a recession and the market's going to react and go down. There'll be some bad news. Don't worry about it, though, because it'll go down and then the buyers will move in and take it back higher.
There doesn't seem to be any threat of a recession right now, right?
No. That's gone.
But they were talking about they had the inverse long-term, short-term interest rates were crossing over and something like that, and that impacted the market for a little bit.
Definitely impacted the market. And the two big things that happened this year was the inverted curve yield went away. That was the biggest story mid-year. That went away because now the curve is back to the way it's supposed to be. And then the China tariff trade negotiations were supposed to be a real negative, turned out to be a very good positive, and the markets responded positively to both. So, like I said, we're up 26% this year.
Okay, and there's only about another month left. So.
Another month, and we're in the strongest part of the year, so it could be a 30-plus year.
Mr. Optimism. All right, 2020 is, of course, a presidential election year. How does the market react to political developments and outcomes, or anticipating political developments and outcomes? We'll find out when we return. You're watching 22 News in Focus. Welcome back to 22 News in Focus. Today we're talking about year-end financial planning with Mark Teed, Senior Vice President of Investments at Raymond James & Associates. Next year is a big election year. Some people believe whoever wins or whoever does not win will directly affect the stock markets and the economy. I guess that's a given.
It's a given. It's a new given, though. In the past, nobody really worried about who the president was because, there was two houses of Congress. To get a bill passed was almost ridiculously tough. But now with executive orders and a more active president, let's say, people are much more worried. People are actually connecting the president with the stock market, which is really, for the first time in my whole career, nobody really ever did that till now.
Well, the president is connecting the president with the stock market.
Yes, he is.
He likes to do that, and of course it's doing well. And you said that we seem to be under no threat of a recession right now.
Right.
So people might not want to change. I mean, I'm not advocating one way or the other, but that's a factor.
There's a very high probability that Trump gets reelected. I mean, if you look at the stocks that are affected because of the China trade deal, the consumer basket of people that are back to work and are paying more taxes, both of those groups are doing very, very well. Matter of fact, both of those groups are beating the market right now. So the market signals are telling us that they're okay with this president and that they don't really want to change horses in the middle of the race.
I understand that and one of the more current recent presidents, and not that recent, was Bill Clinton.
Yeah.
And the mission, or the what do you call it, what they used to call it, what they used to say, they had it on signs on the walls. It's the economy, stupid.
It's the economy, stupid.
And this is what's important to people. It's in their pocketbooks.
Definitely.
This is what they're measuring, and they want to say, if we make a change, how's that going to change what we're trying to accomplish?
Exactly. You mentioned Bill Clinton. The reason people have such a very, strong, positive feeling about Bill Clinton is because the economy was roaring in the late 90s. Oil and gas were $16 a barrel. Unemployment was 4%. Inflation, it was just, and the market was up 90% in 1999. So there's a very positive feeling. So I have a feeling some of that transfer effect might actually transfer to Trump next year. And there's a good chance at this point that he gets reelected.
Well, the price of oil now is about 12 times what it was when Bill Clinton was there. But unemployment is even lower.
Unemployment is lower.
So these are all factors. So what happens during a 4-year presidential cycle normally to markets? What is the normal cycle?
Well, we're right now in 2019, the third year of a presidential year is usually the best year, and it's turning out to be that, the best year of the 4 years. Next year, however, is also a very good year. So the fourth year of a presidential term, it's when all the politicians pour sugar on the economy. So it should do very well next year. We're looking, potentially for earnings to go up 10%, roughly. So that would tell you that the market's probably going to be fine. And with low inflation and not a lot of problems in the world, there's a good chance we have a good market. It's the year after we have to worry about.
I understand what you're saying about next year being important. Nobody wants to do anything to disrupt anything good that's happening.
Exactly.
Do you have some numbers that back that up? Like what is normally a return in a fourth year of a presidential term?
Well, we know going back to 1928 that there's 23 presidential cycles. 19 were positive, and the average was up about 12%.
19 out of 23.
19 out of 23. So it's an 83% chance that the fourth year of the presidential term will be positive. Now, the first dispute of that is back in 2008, where the market was down 37. But that was an abnormal crisis that happened once in a lifetime.
Let's hope so.
Let's hope so. That's right.
So, talk about the difference. Let's go into the future a bit.
Sure.
Let's say that this president does win another term. What's the difference between a fourth year of a presidential cycle and the 8th year?
That's a very good question. Well, by the 8th year, it's really by the 6th year that the market starts getting tired of that person and looking for the next person. It's usually when they do change horses after a second term that it starts to get more volatile. So I would say, in this third year of Trump's presidency, if he gets another 4 years, we've got to start worrying a little bit.
Yeah,
but that's way off.
I was thinking another parallel between Clinton and what's going on now is he also faced an impeachment hearing.
He did. So, but the people liked him. They reelected him. The markets loved him because he was sort of pro-business, and the rest is history.
Yeah, I don't know if all those things still translate. Yeah. Now, if the president is reelected, do you expect much change in the financial markets?
Probably not. Today they were talking about a new potential tax cut for next year. So I don't think so. I think he's still considered pro-business. Even though a lot of people dispute that, he's actually helped business a lot, I think he's considered pro-business. And depending on who the Democratic candidate is going to be, if they move really left, you could see a real contrast between two candidates. But if it's somewhere in the middle, like Mayor Bloomberg, I would say he's a moderate. We'll see. Probably not much change.
Wall Street's probably a little bit excited about Bloomberg getting into the race, I would think.
I would think so.
And that would indicate a moderating factor in what we're hearing, a lot of what's coming out of the Democrats these days.
Definitely. And we heard that from President Obama this past week, talking about a moderation, that we can't do it all in one move. So I think you're starting to see, a different tone coming out of some of the Democrats than we had a month ago.
Nobody really wants to rock the boat, do they?
Not really. Not really. People want things to keep going the way they are, which means the bond market continues, yields continue to go down, but that doesn't happen forever. So there's something out there that we have to worry about, but just not yet.
All right, we got about a minute left in this segment. Crystal ball time. What are your colleagues, your financial advisors predicting for next year?
Another up move. Maybe a little sell-off April, May, or June, but then towards the year end, if the numbers hold for Trump, probably a higher market by year end.
Yeah, I mean, right now markets are at record highs.
Record highs.
Isn't that kind of the time where you want to tread lightly?
Exactly. You always want to sell into strength. So now would be the time if you ever wanted to sell. But it looks like 30,000 is within our view next year.
Well, we'll see about that. We'll be talking about that a little bit later on.
Okay.
After the break, we'll talk about what you should do to improve your financial future. You're watching 22 News in Focus. You are watching 22 News in Focus, and today we're talking about the financial markets and their impact on your savings and investments with Mark Teed, Senior Vice President of Investments at Raymond James & Associates. Mark, well, we should always be on top of our financial health throughout the year. There are some year-end financial strategies we should be paying attention to.
Yeah, definitely.
Talk about that a little bit.
Well, one of the things in my world, if you most of the gains most of the the things you've done this year are gains. But if you have a lot of gains coming from mutual funds, you should look to see if you have any losses anywhere in your portfolio and take the losses against the gains. Because right about now, you start to get an idea of what the capital gains are going to be, and they're going to be pretty big this year. So if you have mutual funds outside of your IRA, be prepared for some pretty good gains this year.
Let me talk about capital gains. You short-term and long-term capital
Yep.
gains, right?
Yep.
The tax rates are different on those two things.
They are.
Short-term gains, you'll pay more.
Right.
So in a way, in some instances, it's good to hold on for more than 1 year. So the short-term gain becomes a long-term gain.
Exactly.
Unless the stock goes down.
Unless the stock, true, definitely. Yeah, you want to hold it. If you have long-term capital gains, you want to match that up with long-term capital losses. You want to hold on for over a year, definitely.
And an exception to that is if you're holding mutual funds or stocks
Yep.
in your retirement account, you can buy and sell, or your financial planner can buy and sell them, and you have no tax impact, correct or no?
Correct. No, correct. Within an IRA, you can do as much as you want, buying and selling, gains, losses, and you don't have to pay taxes on that.
But if you have a loss, you can't write the loss off against gains.
Yeah.
In a retirement account.
Exactly.
Because that's all pre-tax money.
It's all pre-tax money.
It's a lot to keep track of.
Sure is.
This is the kind of thing that you're always talking to your clients about, I guess.
Sure. And my favorite of all those things is to put money into a Roth IRA, which means you can take and convert your IRA into a Roth, but you have to pay the taxes on it. But if you look at your life expectancy and the tax-free compounding rate, because you never have to pay taxes on the Roth, it starts to make a lot of sense. People don't want to do it because you have to pay taxes on it.
It hurts more.
It hurts more.
And I was talking to somebody behind the camera here that to use more of that pre-tax money, because if you increase 1 or 2% of a pre-tax contribution to your IRA, you don't feel it as much. But with a Roth IRA, it's after-tax money, and it's dollar for dollar that you're contributing.
Oh, yeah.
But the benefit, what's the benefit?
The benefit is you have to...
It comes out dollar for dollar.
It comes out dollar for dollar to pay taxes.
Tax-free.
Tax-free, you're right. You're right.
We love the Roth.
Love the Roth.
We love the Roth.
Can we talk about tax-free compounding for a minute?
We can, because I don't know what that is.
Oh, okay. Well, the magic of compounding in the markets is if you put money into a Roth and you put it into higher growth, which is what you want to do for a Roth. And let's say you're 40 years old, and the money grows. You can get it. You put it into an aggressive fund and grow 12% a year. If you divide 12 into 72, that equals 6. That means every 6 years your money is doubling. So if you think about that, 40 becomes 46, it doubles, and then 52, 58, 64. So, 10,000 becomes 20, becomes 40, becomes 80, becomes 100 and 160.
Every 6 years?
Every 6 years your money doubles. It's an amazing thing. Einstein said it was the greatest thing he ever discovered was compounding of interest.
I've heard this. There's a magic of compounding.
Magic
interest.
of compounding.
So you're saying if you do that within the confines of a Roth IRA,
Yep.
the compounding, it will double every 6 years.
Yeah.
Assuming you get what kind of return?
Well, 12%. So you divide whatever return you get into 72. So it works in the Roth beautifully because you never have to pay taxes. And, it works in an IRA too, but when it comes out, you have to pay the taxes. And if it's in a regular account, it doesn't work quite as well. But the concept is the same. You want to compound your interest over time.
If you have it in, say, a normal savings, or something outside of an IRA, outside of a retirement account.
Yep.
So if the money doubles every 6 years, each one of those years you're going to be paying taxes on whatever the gains are.
Probably capital gains tax in there if it's in mutual funds. But the difference between a 12% return and a 2% return, you divide 2 into 72, that means your money doubles every 36 years. It's a lot slower. So the beauty of the markets over time, if you're really a long-term investor, is you let the money sit and grow over time. You'll be very happy.
All right, you're going to have to tell me where that fund is where I get the 12% every year. That'd be great. But it's over time, though.
Over
of course.
time.
It averages out.
Yes.
How about planning for your tax liability? How do you do that?
Well, that's talking a little bit about the Roth. I mean, when you do retire, what you have to tell people is you have to think about the different sources of income that you're going to get. You're going to get Social Security. You might get a pension if you're lucky.
Fewer and fewer companies are offering pensions, of course.
Right. You'll have an IRA or 401k or 403b plan. That comes out taxable. And that way you want to have another source of income called the Roth where income can come out tax-free. So, or if you have a life insurance plan, money would come out of that potentially tax-free if you borrow against it. So you want to have as many different sources of income as possible, which is hard to do.
And if you're getting your Social Security, I understand, and I found this out because I talked to my accountant recently, that your Social Security money is taxed at different tiers depending on how much other money that you bring in.
Yep.
And if you're taking money out of a Roth IRA, that's that income does not count as income, and you can keep your tax bill lower.
Bill lower, absolutely. It's the conversion to the Roth that gets people. They won't do it because they don't want to pay the current taxes. But it's so beneficial to have that in retirement income. It helps your Social Security, it helps your Medicare premiums, everything.
I want to talk about taxes on Social Security. Why do they do that? Why do you all have to pay taxes on Social Security?
That was 1988 catastrophic care coverage bill. Claude Pepper pushed that out. They were going to pay for long-term care. If you just increased taxes on Social Security, that's when that all went way up, 1988. A painful year.
All right. Talk about really quickly required minimum distributions, RMDs.
Yep.
So when you get to be what, 70 and a half?
70 and a half.
You have to start taking money out.
Yep. The government allows you to, your whole life to grow your money through your 401k, your 403b tax-free. But then when you start taking it, they want their money back. So at 70 and a half, they start mandating that you have to take a certain percentage out each year until you die. So that's how they get their money back.
And if you don't take it out?
You pay a penalty. For half, I think it's half of whatever you're supposed to take out that year.
That's prohibitive.
It's prohibitive.
That is awful.
It is. But it's a great vehicle. I encourage people to use their IRAs or their 401k plans.
Should people be creating new accounts as we get to the end of the year, retirement accounts? This
Yes.
is a good time?
Yes. If there's any way at all to put money aside that would either give you a tax benefit this year or put money into an account that will grow, definitely.
All right, good advice.
People don't save enough, Barry.
I tell everybody to save, and then till it hurts, and then a little more.
I know.
All right, we'll have the last word after the break. You're watching 22 News in Focus. You've been watching 22 News in Focus, and today we've been talking about year-end planning, effective strategies when considering your financial plans. And that is our program for today. We want to say our thank yous to Mark Teed, who is the Senior Vice President of Investments at Raymond James. And he provided some professional expertise and some lively opinions as well. And thank you at home for watching. If you missed any of it, you can watch it in full on our web at WWLP.com. Have a great day.